estate. Now your client, your case study, your clients are a married couple. What they have is they have a bunch of money and they have this business that they want to transfer. Okay? Now, they want to utilize the gift tax annual exclusion to transfer the business, which you should, right? Which means you can transfer, it's not just money at the annual exclusion, right? You can transfer anything of value up to 18,000 this year, right? My mind's going today. I'll see if I can keep it together for the next 45, 50 minutes. All right, so keep in mind everything we're talking about today and what we talk about in class on Monday should be looked through the lens, of minimizing the gross estate. Your clients have so much money, so many assets, okay, that they need your help to transfer this to their loved ones so they don't get taxed. Okay, and this is what transfers at life and at death are going to be. So the focus is going to be reducing the gross estate. Okay, so when we talk about lifetime transfers, the title of this chapter, we're not talking about gifts. Okay, this also includes sales and other types of transfers, whether you're related or not. Okay, now when property is removed from the gross estate, let's say, right, I sell something, right, as this way, okay, now, does it really reduce the gross estate? Let's focus on the sell. I have a business worth $1 million, it's include my gross estate. If I sell it for $1 million, has my gross estate been reduced?
No, it's the same.
It's the same thing, it's on net worth, right? Switch on net worth. Okay, because the consideration that you received to sell that property, right, is included in your gross estate. That make sense? No? Any questions? Yeah. So if I sell a business when it was worth $1 million and I get $1 million in return, it has zero effect on my gross estate because now that business is out, the value of $1 million is out, but I did receive $1 million. It's like net worth, like no impact on net worth. Okay? So that's exactly kind of what's going on here, is that we want to find ways to make these transfers effective, right? So we can minimize our gross estate going forward. Okay? Now, significantly, we want to focus on types of transfers that have a lot of potential for appreciation. Okay, we want to freeze this asset, this value of this asset. Sorry. Footprint. Oh man, I was about to say all kinds of bad words. Sorry. Let me catch you up. We are looking at minimizing our gross estate. Okay, our case study we have coming up is going to be based on transfers during life that don't involve gifts. And what we're trying to do is your clients are going to have so much money, so many assets, that they're trying to give things away. They're trying to give it in a way that's going to reduce their gross estate. So we're looking at trusts, okay, sales, business structures that we'll talk about this month today. So keep in mind that that's what we're doing.
Okay, thank you.
Yeah, no problem. Now, this allows for family members, senior family members, to transfer assets that have appreciated. So let me give you a quick example. If I had a business that's worth $1 million now, and let's say I live to be another 20 years, in 20 years it goes to be 20 million, all that's in my gross estate. If I just wait till I die and pass it to them, that business had a lot of potential for appreciation. Now, if I transfer that business when it's worth $1 million, guess what happens? My family still gets that appreciation, but it's not included in my gross estate. So that's kind of what we're looking at here. So we're trying to transfer assets that have a lot of potential for appreciation now, because whether I transfer it now or when I die, my family's going to get it. It's just if I transfer it when I die, Uncle Sam's going to reach my pockets and take 40%. Okay, obviously this one's worth over $1 million. So keep that in mind. All right, so all the way, this is kind of a little bit confusing, okay, but this graph talks about how all of these affect the gross estate. Okay, now any kind of support, okay, it is excluded from my gross estate. What that means is the money I spend on other people reduces my gross estate. Okay, and that's fine. Okay, I'm spending money, I'm allowed to do that. Okay, the IRS can't say you can't spend money, all right? Any type of qualified transfers, what was a qualified transfer? Do y'all remember?
To like a college or
Exactly.
hospital.
Yeah, so that's not subject to gift tax, right? Now keep in mind, the gift and the state taxes are unified, okay, so they're kind of used interchangeably, okay, for these purposes. That's excluded. That money, I get to run out the tank, okay, with qualified transfers. Same thing with the annual exclusion, right? If I give below or up to the annual exclusion, my gross estate's reduced by that much. Any future appreciation, if I give it away now, as opposed to when I die, all of that appreciation is excluded from my gross estate, okay? So that's kind of the idea of what we got going forward. Okay, so let's talk about removing things, okay, assets. So this is what they call arm's length transactions, okay? A sale is just exactly what it is. Okay, it is a direct transfer of assets, but you get something in return, usually the same fair market value. All right, so at that point, okay, it really has a zero effect on my gross estate. Okay, you know what an installment sale is, right? So I've sold a business, and instead of just giving the money outright, I'm actually receiving payments. Okay. Any remaining balance, if somebody doesn't pay me off all the way, under this is simple terms, okay? We're not planning yet. This is just the way things are. If somebody still owes me $1 million on an installment sale, okay, that outstanding owed, okay, is still included in my gross estate. Okay, and then this again, simple exchange, is just a mutual transfer of assets. Doesn't really impact my gross estate, okay, if they're of the same value. One screen to the legs. Okay, so different from arm's length transactions, we also have transfers to loved ones. Okay, some transfers are not subject to gift tax. Some things are just outright gifts. We'll talk about this today. Kind of going to be our focus. Oftentimes in trusts, we can do a partial sale, partial gift. If I sell somebody for something less than the fair market value, the remaining difference is considered a gift. Okay, we're going to talk about self-canceling installment notes, SCINs, okay? I know it sounds kind of gruesome, but it is. And private annuities. We're going to talk about different types of trust, okay? And then we'll look at family limited partnerships at the very end. This is going to be the important one. I'm sorry. You good? Okay, these are transfers, okay, particularly to loved ones and spouses that are not subject to gift tax, which means has no impact on our lifetime exclusion. Any kind of legal support, alimony, child support, okay, that's not subject to gift. Again, we talk about qualified transfers. Any below market rate loan, okay, if it's non-family member, you'll have to use the AFR rate. Okay, so if I give somebody a loan for 5%, but the AFR rate says it should be 7, I have to use the 7. Okay, or they have to use the 7. Now, if it's to family members, sometimes you'll have to impute the interest as a gift. Okay, if you give them a below rate loan or don't receive it back. Okay, we know transfers to spouses, right, are exempt because of the unlimited marital deduction. As long as your spouse is what?
A U.S. citizen.
U.S. citizen. Non-U.S. citizens, you have what they call a super annual exclusion, that you can do 185,000 every year. We good? Okay, now, if we give outright, or we give into a trust, okay, we can use the annual exclusion to remove assets out of our gross estate with having no impact with our, as a gift, if we use the annual exclusion, okay? And if we transfer a lot of money in there and they don't have a gift of present interest, you can use your current provision to begin to use these gifts of present interest over time. Okay, and what that does is you should be putting these two together. The trust with the current provision and the annual exclusion. Okay, that way you remove the assets from your gross estate and has no impact as a gift. Now, this is gonna be the trick. I'm giving you a little cheat sheet. You should be figuring this out. But when it comes to your case study, you're trying to figure out how to transfer assets, particularly the business, through a family limited partnership. There's gonna be a strategy to this. Okay, now your book has some good examples of how this is done. To reduce the gross estate, again, we want to remove assets with future appreciation and assets that will have income. Because if you have income, your estate's just going up. Now, what we're looking, I know it doesn't sound maybe not intuitive, but you gotta think about it in the terms of grandma and grandpa, they're getting close to the end of life. They really wanna transfer these assets to family members no matter what. In any case, they just wanna do it in a manner that they're not gonna be taxed. And who wants to be taxed, okay? And so, this is what we're looking at. So we're gonna identify assets, okay, that have income potential or appreciation potential. And those are the ones we're gonna focus on getting out of our estate, okay, through a trust or sometimes an outright gift. So here's a really good example, okay, of what I'm talking about. Felix, he started a company, this is a real simple example, with 1,000 shares. And each one, okay, he started for $1, he put $1,000 in, so it was $1 a share. After this contribution, he immediately gifted 100 shares of the stock to his two daughters and filed a gift tax return showing that the fair market value of the gift to be $100, okay? Which is pretty simple. I don't know why he even did a gift tax return. The gift is exempt, okay, because it is a gift of present interest and it's under the annual exclusion, okay? 3 years later, okay, there's a 3-year look back. You remember that? This is what this is talking about. Okay, after the 3-year look back has expired, right, the shares are now worth $5 million, $5,000 per share. That's a business I want to talk about. This is exactly a business with great appreciation potential. Okay, he has successfully transferred approximately $1 million to his daughters while only using his annual exclusion. Okay, this is a real direct, simple, that he was under the annual exclusion, appreciated quite a bit, so he was essentially able to transfer $1 million to his daughters. Had he waited and died, this would all have been a taxable source of the state. So keep in mind, that's what we're thinking about. Okay, I'm really trying to, I know you haven't seen the case study yet. I'll introduce it at the end of next class, because that's what we'll work on the following class. We got an exam on it. Anyway, it's coming up.
Wasn't the exam on 30th?
Yeah, I think so. I don't know. It's on there. We have this class, trust, right? And then review. And then, okay. Anyway, it's coming. The case study is going to be introduced there somewhere, okay, according to the course schedule.
For the 3-year look back period, what's that for this situation?
Yeah, so if you gift property, okay, within that, and you die within 3 years, okay, then that's going to be included in your gross estate.
I thought if it was like you made a change to it or something like that, or is that just for life insurance?
Life insurance had a.
So it's like if you changed the beneficiary, then it was included in your gross estate or something like that.
No, if you bought the policy and you gave it to somebody else, that again, that's going to be up for you to look back. The life insurance, I don't know if it had any special rules, but there is a 3-year look back for any gifts, right? Transfers that are subject to be included in your gross estate. You gotta live that 3 years, okay? Keep that in mind. Okay, so anytime you do a bargain sale, particularly to a family member, okay, the difference between the fair market value and the price paid is gonna be considered a gift. All right, so this is an easy way to transfer assets at a cheap price, but you start to impact your gift tax accordingly. And this is really simple, okay? Somebody had an asset worth $100,000, they sold to their sister for $75,000, the remaining $25,000 would be considered a gift. Now, now if you're married, you can make the election to gift split, sell this, right? Remove it from your assets, your gross estate. We always consider that we're trying to reduce our gross estate, okay? And we still be underneath, right, the split gift and exclusion for spouses. So this would be a good way to transfer assets to somebody, especially one that has a higher potential for appreciation. All right. For those of you in the last class, we're going to talk about annuities a little bit more. All right. Anyway, you can do private annuities. Usually you get annuities through an insurance company. Who's familiar with an annuity? Who have no idea what an annuity is? We just talked about last class. Okay. An annuity is an insurance product that you'll invest money into, and then it guarantees. So, for example, I put $100,000 in there. I'll let it grow to, let's say, $500,000. It's a retirement product, so at 59.5, I can start to access it. Well, I turn it on, so it's worth $500,000. Now, in the purest form, is that the insurance company is going to find, based on my life expectancy and their profit, how much money I'm going to get for the rest of my life, or for a specific period of time. I am guaranteed that they're going to, and the problem is you use these products because you have in a problem or you're not sure how to handle this decumulation of assets. Okay, but the problem is when it comes to this type of private annuity, it's an unsecured promise from the annuitant, right, to make payments to the remainder on the annuitant for the rest of their life. So typically what you would do is, again, you would transfer appreciating assets at retirement to produce retirement income, okay, for somebody. So I'm going to take this business or whatever I have that will appreciate, transfer it, okay? That way the appreciation will now be subject to the younger generation. It'll be removed from my gross estate. I'll have retirement income. And a lot of these, once it's transferred, freezes that value. Okay, so even if it does appreciate, it does not affect your gross estate. It freezes the value for your gross estate calculation. Okay. So that's what a private annuity is. Transfer of assets for return of income. Okay, self-canceling installment note is similar to a private annuity. Okay, but it's exactly what it is. I'll transfer assets and then I'll receive payments, and then when I die, the note is canceled. Okay? Now this is oftentimes done when somebody's in bad health. Now, because the person who's in bad health may not get the entire return of the actual value of the asset transferred, there's gonna be a premium, okay, on the sale, or at least on the payments made to the person who transferred it. Now, based on this premium, the risk to the buyer is that if the person lives longer than they anticipate, they may end up paying more than the actual value of the business. These sound very similar, and we're going to talk about some of the differences between private annuity and the SCIN. Okay. Now, like I mentioned earlier, a private annuity is a unsecured promise, so there's no collateral. The asset's transferred, income is supposed to be coming in, but there's no way to redeem that as collateral anymore. A SCIN, okay, you can collateralize the property that was transferred, okay, so that's a good one. You can deduct the interest if the asset would normally be deductible, could be a deductible asset, okay? If you use a SCIN, any interest accrued on a private annuity is not deductible. These are just things. Now, they both have similar risks, okay? That the person's going to default on the annuity payments or on the SCIN installment payments. That the money I receive, because oftentimes it's a fixed amount, okay, it's gonna be eaten up in inflation. It's not gonna have the same purchasing power as it would. In both of these, the risk to the buyer is gonna be if the person whose life, the annuitant, or the person who transferred the assets and is receiving the payments now lives too long. That's just the issue, which is kind of like the risk. Thinking about this through the lens that we're trying to get rid of assets. In return, we're gonna get some property or some income back. For our purposes, we're gonna freeze the value. If anything, okay, was left, I'll get to that in a minute.
Is longevity a risk to the buyer of both?
Yes. Well, sorry. Longevity of the buyer?
Longevity of the seller.
Yes, sir. Yeah, because the annuity is gonna be based on the life, okay? And if they live longer, just like any annuity, then it's subject, to overpayment. But because the SCIN, possibly that guy's or whoever's supposed to be in bad health, there was a premium because they are subject to not receiving the full consideration because, hey, I might die, because the note cancels itself in the event that person dies. So there's always like a premium to that payment or to that asset, okay, to be received by the seller. Yeah, okay. In that manner, if they do live too long, then the SCIN is going to also have longevity risk. Okay. So we talked real quick about private annuity, okay, outright gifts, private annuities and SCINs. Okay, so those are going to be like transfer of asset for income. Now we're going to do the similar interest here. Okay, but these are called Grantor retained trusts. And there's going to be three of them we're going to talk about. A GRIT, I swear I cannot make this up. A GRAT, and a GRUT. Okay. Okay, and if you haven't figured out, it's Grantor retained. Okay, and then we'll have other elements to this. Okay, so let's talk about what a Grantor retained trust is in general. All right. Now these are irrevocable trusts where the grantor is a person, okay, this is going to be good for definitional purposes, who transfers the assets. Okay, and then retains, so there we go, grantor retains an interest in income or some kind of annuity stream or something like this. So similar to what we talked about, but this is utilizing a trust. Now, what happens is the remainder beneficiary, okay, usually a family member, receives that property. Bless you. Now, because it's revocable, we'll talk about this next class, it immediately will qualify, not immediately. It will qualify over a specific period of time to remove the asset from the transfers gross estate, even though they have an interest in it, they're retaining an interest. That was always kind of the stick.
I think we have one of those in our case study. The Benny and Jerry or whatever.
Is there one in there?
I think like they had something where a charity was retaining the actual assets, but they were still making the income.
That's so now they have a CRIT, GRAT, and GRUT. A charitable retained, and then we'll go through the process. So the GRIT retains, the grantor retains income from the trust, while the beneficiary receives the property for a specific period of time. Grantor retains an annuity for a trust, okay, for a specific period of time, at which point the remainder person will get the property. So now it's all removed after that period of time. And the Uni-trust is a variation of an annuity, but this is kind of the worst one you want to get into. Yeah, they have GRAT, GRUT, and then, they got a lot. So I'll try to break these down as simple as possible, okay, the benefits and risks, okay. So, we're looking at transferring appreciating assets, okay. It comes out of the asset of the gross estate of the transfer, okay, that's what we want. Now, the risk to all of these is that these trusts have terms, 5 years, 10 years, 7 years. Okay, if the grantor does not survive the term of the trust, because they have a retained interest, it is included in their gross estate. Okay, had they given up all interest and passed the 3-year look-back period as a gift or whatever purpose, then they wouldn't have to worry about that. Now, the value of the gifts associated with this, okay, is the fair market value of the assets transferred minus the present value of the retained interest or income stream. Now, sometimes people will transfer property or homes to a trust like this too, and retain the use of the property or the home. We'll talk about those too. Okay. Same concept. So we're gonna look at these three individually, and I'm trying to break them down for what they were. You have a trust. The grantor transfers assets, retains an income interest. This is why it's called a GRAT income trust. Okay? And at the end of this process, after the term, the defined term, the assets have been transferred over. The grantor no longer retains any interest in the property, so it is therefore officially removed from the gross estate. Now, what's interesting on this one is that you do not have to distribute the income. So you can allow the income to continue to appreciate or stay within the trust. Okay? If it's an appreciating asset, the transfer, okay, subject to any kind of gift taxes, is lower because the value of the property has not appreciated yet. The risk is the same for all of these. Simply, if the grantor does not survive the term of the trust, then at that point, it is included in the gross estate. Plan on what to kaput. For lack of a better word. These are all going to be very similar, okay? But this is a kicker here that you don't have to distribute income. Okay, GRAT, same concept. The grantor donates property to the trust, okay, and in return receives an annuity payment. Now, the difference between income and annuity payments, I know you're both getting money, but income is not specifically defined. Okay, an annuity is a more formal contract. The annuity will either be a stated dollar amount, a fixed fraction, okay, of the trust assets, or a percent of the fair market value of the assets. Now, this one, you do have to make an annual distribution, as opposed to the grantor retained income trust. Alright, so some consideration is coming back based on a fixed percentage, stated dollar amount, or whatever, okay, of the assets that are transferred. Now, you can typically do a bargain sell, okay, but you have to use the AFR rate if you're going to do a bargain sell. So anytime you want to use a GRAT, it's if the property is going to appreciate higher than the imputed AFR rate. That way you're removing and appreciating property faster than you would be just through an installment sale. Same benefit. Okay, all the assets are transferred at lower gift tax value now. Same risk. The big difference here is there's an annuity based on a specific something, okay, and the annual distribution is required. Okay, so this is the one that's not really the best, okay, because it has more restrictions to it. Okay, this is very similar to the GRAT, the annuity. Same thing happens. You transfer assets to irrevocable trust, irrevocable, however you want to say it, which means you cannot no longer take this back. This is a done deal. You receive an annuity for a defined term, 5 years, 7 years, okay, whatever you figure out. Again, at the end, the beneficiary receives the assets, which is what the whole purpose of this was about. But this one is that it pays a fixed percentage of the trust assets per year. Okay? There's always, on the last one, sometimes a fraction of a percentage of fair market value, all right? But this one's always re-evaluated every year for the fair market value of the assets. The other ones are not necessarily re-evaluated every year, okay? And the payments are adjusted for inflation. So what that means is the more consideration that the person who's trying to get rid of the assets, they're getting more back, okay? And if the assets in this GRUT, in this trust, actually appreciate more, there's a fixed percentage attached to that. So then there's more consideration coming back, okay? And because you have to reevaluate the value of the assets in the trust, they're not suitable for hard to value assets, okay? Maybe you have a closely held business that, you sell, I don't know, rubber tires to only one person. No, something's very difficult, okay, to value. Who's gonna buy this? Same benefits, same risks. Okay. There might be a less value of assets transferred to the beneficiary, okay, if the grantor is receiving higher and higher payments. We're halfway there now. Okay, let's take a look at an example. You might need me to go back. Okay. On a solid create a Grantor retained annuity trust, okay, it needs to require annual distributions. For the term of 7 years, you contribute appreciating property with a fair market value of $1 million to the trust. She will receive income from the trust each year, and at the end of the trust term, the property will be distributed to her daughter. So you may have to calculate the present value of the income stream, okay? I'll give you an example if you want, not today, but if that becomes up, okay? So you have to identify the present value of the income stream calculated, okay? So the gift of future interest is gonna be the difference between the actual amount of property appreciated, okay? Yeah, appreciated property donated, and then the present value of the income stream. So there's a gift of $300,000. So she will report a taxable gift of $300,000 as opposed to $1 million. That makes sense? And then any appreciation in the future. So yes, you're not completely avoiding some kind of taxation, but you're severely reducing the amount taxed. How y'all doing? You all right?
Installment sale to an agent.
Okay, well, let me come back to this. we get to family limited partnership.
Family limited partnership?
Yeah. We'll talk about IDGIT. I might bring it up next class a little bit, but it's got a lot of rules. You don't look at me like it's 4:45 on a Wednesday, okay? Okay, so remember I told you we're discussing donating property, appreciating property, okay, of assets to a trust to receive income or annuities. Appreciating property is not the only thing you can donate, okay? You can also do a personal residence, okay? Where you donate a personal residence, you'll get income, okay, by the use of this. And typically, the benefit, the grantor still gets to use the house. So now I'm taking my house out of my gross estate. I'm receiving some kind of income for it, right? Just like we had the $1 million in the last example, I'm only paying taxes on $300,000. Okay, there's gonna be some kind of transfer for value there. And at which point I still get to use the house. Okay, so this is what they call a qualified personal residence trust, a QPRT.
Wait, so what happens? So you still have to leave that to a beneficiary?
Yep, same thing. It's just like a GRAT. So you transfer the property. It may not be appreciating quite.
So does it transfer like immediately, or does it only transfer at death?
At the end of the term, it officially is removed from your gross estate. So I'll transfer the property. I'll receive some income for that transfer. And then the difference between what I sold, what I transferred, and then my income stream would be the gift. Kind of like the same thing with the million.
Okay, so like say you had bought a rental property for your kid.
Personal residence.
Oh, dang. Say
I like your thinking.
Say you had your personal residence, right? And you wanted to give it to your child before they went to college, so that way they could use it as whatever, so that way you could move to the beach in Florida.
Yeah, so
you know, you could like essentially like avoid a larger tax bill by using a QPRT.
okay, yeah, so the idea is that, let's just stick with the example. Let's say the house was $1 million. Okay, if I give it to my kid right out, then I'm taxed on $1 million as a gift tax, correct? Okay, if I use one of these and retain some kind of income, let's just use the same thing that we had a while ago. Okay, then the value of the gift that will be taxed is only $300,000. Now my child, I don't get to escape taxes completely.
Yeah.
But I get to reduce my taxable amount. My kid gets the house, okay, and it's removed out of my gross estate. If I were to sell it to them, then of course it just transfers the consideration. Okay, if I give it to them, then I'm taxed on the whole $1 million because it's considered a gift. Okay, this is just a good way, and what I do with this money, it doesn't matter. Okay, I can do it. I can give it to my kids.
So it's essentially just a good way to give really large assets to kids without a huge tax bill.
Yeah. That's all we're doing.
Or to family members or whatever.
And these are not as uncommon as you may think. Same thing though. If I die or the grantor dies during the term, okay, it's still including the gross estate.
So how does grantor maintain the rights to the property?
That's just what is stipulated in the trust documents.
I mean, technically after the transfer, wouldn't it be? So you only get the rights to the property in the middle of the transfer for
Usually,
that term?
usually it's going to be for family. So hopefully your kids don't kick you out. But no, I think you actually, by law, the way that this is set up is that you have the house until you're dead. And then once you're dead, then the property is transferred, outside of probate, because it's in a trust. Minimize gift taxes. Because if I hold on to that property and I die and I transfer it to my children, it's including my gross estate, it's taxable.
Yeah.
So. All right, same thing for tangible personal property. Okay, instead of a personal residence, it's just personal property. Okay, that you retain the right to use. Maybe this is jewels, okay, maybe this is whatever. Maybe it's a nice Ferrari, 69 Ferrari, okay, whatever it is. So these are just particular types of GRITs. Okay. Let's see. Okay, this is very, very common. Okay, this is oftentimes the way to do it. So this is, I pay a little attention on this. I'll make sure you read over in your book, because for your case study, this is going to be a solution I would highly recommend that you use. Okay, so you have a business, okay, or something. You create a partnership, okay, between what they call a general partner and then limited partners. Okay, so the general partner retains a 1% interest into the, let's just call it a business. And the 99% of limited partnership is transferred somehow using special techniques to the beneficiaries. It could be grandma and grandpa on a farm, and they want to transfer this to all the 15 grandkids. Okay, they are all considered beneficiaries. Now, when you oftentimes sell hard to value assets, or even to family, you can use what they call a business valuation discount. You also create a layer of asset protection from creditors, okay, because it is a limited partnership. Are you familiar with business structures? Okay, limited partnership. And what they're designed to do is reduce the value of the business because of the lack of marketability. Let's say this is a family-owned farm, we're not gonna sell to anybody else. Not a lot of people wanna take over family-owned farms. Okay, so it's not very marketable. It's not like stock. We wanna use gift tax annual exclusion to transfer these shares to our beneficiaries over a period of time. That's the idea here. So now we get to transfer, it's a qualified transfer now. So we get no gift tax, we're removing this value, this appreciated property out of our estate. Okay, do what they call a family owner partnership. Now you can't just, it has to be a business and be operated as a business. You can't just toss in, you can't make something up and call it a family limited partnership. Because it is technically a limited partnership, the LP, it's gotta have its own county checkbook, okay, your own taxes, you'll file its own corporate tax. Depending, yeah, because S or C corp, I figured that out. Okay. Basically, all the things that you're taking advantage of, you just cannot do. Okay, this is not like a Hail Mary, okay, so grandpa's about to die, let's create a family owner partnership. That has not been the intent, and that's not gonna look good for the IRS. Okay, you cannot take the valuation discount if it's a highly marketable asset. You can't say, oh, I need a marketability discount because this property is highly marketable, okay? The reason why you can't use personal use assets is because it's supposed to be for business purposes. It's supposed to, most of this is going to be abuse of a business, okay? It's really, the rest of it's gonna be, has to be run like a business.
Wait, so then why would you use, it's only in like the case of like a family business or something like that? Like if you own a family bakery or something?
You have a highly appreciated business
Yeah.
that you wanna transfer to beneficiaries without, because if you do a below market loan, you have to impute that. The purpose is really, you've got this setting up in time where you have, however what's the value of the business is and however many beneficiaries you are, it may take you 20 years to transfer using the annual exclusions.
Yeah.
To transfer all, if it's a highly well business, so that's the idea, is that you are slowly but surely taking advantage of this to transfer all of this out of your gross estate. yeah, your book has a really nice, okay, talk about it. I'm not gonna go through this whole thing with you right now. But yeah, I recommend you take a look at this. This is gonna be coming really, really handy for you, especially when you do your write-up or your case study. You should be pulling ideas from this table right here. Okay. We're not gonna get to Medicaid planning. I do wanna talk about this though. Everybody has your lifetime exclusion, right? 13.6 something million right now. Okay. You can transfer from your deceased spouse to you any unused lifetime exemption. Okay. So technically, a married couple has 13.6 times 2, so 27.2. Okay. Worth of assets they can transfer. Now, how you use that is completely up to you. What we talked about today is everything, transfers during life that'll minimize the taxable transfer, right? But ultimately, you and your spouse can combine. Okay, now if you have 5 spouses, you can't, right? You can't have all 5. Okay, you have to take the one that's most recent in this scenario. You get married 5 times just so you have like $60 million you can transfer. Anyway, that was the key that I wanted to talk about at the end of this today. So, it comes in handy because property can be transferred between spouses using unlimited marital deduction. So usually the surviving spouse is stuck with all his property now. If they didn't pay gift tax on initially or estate tax on, but eventually will pay. So it allows them, right, to take over what's not used and then apply it to the surviving spouse. And we talked about all this. Okay. That's all I got today. Do you have any questions?